The fact that it is people realize that SWP is one thing which can provide solution to many uh, reasons in life. Whether it was related to people who were retiring or who had retired, they needed a regular inflow to meet their expenses and things. Of course, as you would agree, not everybody gets pension, or even if they get pension, sometimes some additional expenses or some additional inflow in the form of a fixed cash flow is always favorable, or it is always better post retirement side. Similarly, there were some innovative thoughts which came in from many people's side, like why not giving a regular inflow to a homemaker who was working prior to marriage or otherwise, and who is currently not able to earn on her own, but still a fixed earning going or fixed flow going in her bank account so that she can manage household expenses or her own expenses. So this was another innovative point which came out from SWP as a strategy. There are many people who have got their kids studying in boarding or away from them. Giving a pocket money on a regular basis, be it for fees, rental, or any other thing, is one need which need to be covered up or fulfilled, for which SWPA once again fits in very well. The fixed flow of money getting into the bank account on a fixed date. And all this, while we are talking about different solutions, I'm sure there are many things which would be coming in your mind also. uh, all of these have got one thing which is very common. Mutual fund provides this flexibility. Second thing which is in common, the possible tax efficiency of this mode of regular inflow is something which is very, very unique. You can get into more details as you go through the calculations. And of course, the flexibility many of the mutual funds provide by, in a way, relaxing the exit loads for within 1 year withdrawals and so on and so forth. So there are many benefits which have been extended to SWP strategy in mutual fund as a category. And for this, we have rolled out, and our colleagues on ground discuss one campaign with you, which we internally call as 1077. To know more about it, I would recommend, I would suggest that you interact with all our relationship managers across India to understand more what is 1077 and how it can benefit your investors. And at the same time, keep your business afloat and flourishing. So without any further ado, I would invite and introduce our colleagues from Sundaram Mutual Fund. So we are really privileged to have very senior colleague from Sundaram Mutual Fund, Mr. Rajiv Chabaria, who happens to be the Deputy Business Head at Sundaram Asset Management, and Bhavik Arya, who is one gentleman we have actually seen growing uh, on across the business sides of it. And today we are joined by Mr. Bharat S, who is the head of equities at Sundaram Asset Management. Bharat has got more than 2 decades of experience across equity research and fund management side of it. He's been associated with Sundaram Asset Management for almost 20 years. He started as a research analyst, then got into active management. And if you know his the schemes that he's managing is what we are going to spend more focus and time on. And Sundaram Services Fund plus Sundaram Conservative Hybrid Fund. So in a way, across the spectrum, equity oriented. Some are jointly managed, of course, being hybrid otherwise. So, but the getting insights from Mr. Bharat is going to be special highlight for the day. Mr. Bharat, who is an MBA and certified FRM and cost accountant, hails from a beautiful city called Madurai. I'm sure we'll have good learning today that with the time that we are going to spend with Mr. Bharat. Bharat, over to you and welcome to the call with our partners.
Hi. Thanks, Mr. Gautam, and really a pleasure to join you all in the call today. So, Mr. Gautam, if I may ask, how do we structure this? Should I give a brief for the first 15-20 minutes and then we open up? Will that be fine?
Yeah, that would be great. If you can share some insights into Sundaram Balance Advantage Fund, market view, and then we can have an interactive session with our partners. Yeah.
Fantastic. Great. So I'll just share a brief deck as well, just to keep the connect to the product which I'm studying here. So as the name suggests, more than calling it a balanced advantage fund, it's a dynamic asset allocation fund, which is what we're dealing in terms of the traits of the product. So to start with, when we as investors walk into equities, the typical questions which we always encounter is, as usual, the first one is what to buy, the second is when to buy, and third is how much to buy. And if there is one product which kind of reasonably addresses all these questions, it is this category product, which is dynamic asset allocation category, which has some of these answers for investors who are especially grappling with any of these questions, which I just alluded to. So from a overall thought process, what is this product all about? There are three essential traits in this products. Number one, this product is all about not returns, but managing returns with risk taken care. So it is about managing a risk reward through dynamic allocation of capital towards equities. Now, what does it do here? From an investment perspective, there are times when markets are emotionally in a zone of greed, and there are times when emotionally markets are in a zone of fear. So when markets are too greedy, obviously there are certain indicators which capture the greed. So the chances of making money when everybody is greedy is probably lower than chances of making money when everybody is fearful. So the whole idea is to capture these dynamics through a framework. So the first essential trait of this product is to keep away individual biases, look at certain indicators which can reasonably capture the zones of greed and zones of fear, and curate the equity allocations accordingly. So what do we do here? Increase equity allocations when there is fear in the market, and start booking profits when there is excessive greed in the market. That is the essence of a dynamic asset allocation category. And for that, there is a framework which I will spend a little bit of time as we go along. So that's number one. The second is in terms of the advantage for the investor. What does he get out of it in this process of dynamically allocating capital on the equities based on a framework? He's taking away the timing risk of the market. There are many times where we've seen investors who book profits, but the extent to which the profit booking can be so severe that if there is a fairly long period of market greed, the upsides are lost in that process. And so is a case where one might be too early in a trade, and it could be buying it early also at times, results in inefficiency in terms of capital deployment. So the timing risk of it is taken away when one follows the framework into allocating equities based on certain indicators. The third is moving away from equity into fixed income. How much efficiency or inefficiency is attached when one does an individual capacity versus one doing it through a product like this. So over here, the tax advantage or the efficiency of doing between equity and fixed income is still captured under a equity taxation umbrella. So these are broad, I would say, starters in terms of why this category is of relevance for any asset allocation for an investor. And quickly moving to what we do at Sundaram Balance Advantage, clearly I would say this is a product where the first point which I mentioned in terms of dynamic equity allocation, we use the Nifty 50 trailing 12-month price earnings as a broad indicator to see where the emotions are in terms of market readings and invest equity accordingly, which I'll again explain a little. How does it invest in equity? We invest on a multi-cap style basis, which means we have a blend of large caps and mid caps in this. And the extent to which we move towards large caps and extent to which we move a little bit more towards mid cap is again based on an internal framework. The third is how we invest in equities in terms of stock selection. Again, I'll take you through that in terms of selection framework. How does a portfolio behave in terms of diversification? The portfolio is reasonably diversified across 50 odd stocks with a fair amount of, I would say, bets spread across sectors, which means we take limited active sector bets. We spread ourselves with a fair amount of sector choices, but focus at a stock level to size up opportunities that we see. So when we spread ourselves with moderate sector bets and focus at stock level, the whole outcome of it is that we limit portfolio volatility to a reasonable extent than running a concentrated portfolio. And when it comes to fixed income, which is the other part of the product, outside equities, where does the money go into? It moves into fixed income and arbitrage. So fixed income, the whole idea is to focus on high quality papers, AAA and G6 to a large extent, and focus on accrual. Now, quickly get into equities. Where do we see our asset allocation? How do we do it? What is the methodology all about? It's a very simple methodology, which even though simple, it's been from a time-tested basis, it's been fairly handy to call out extremes in the markets. So we use trailing 12-month Nifty PE to identify where our equity allocation would be in terms of market conditions. And once the identification is done, we invest the equity and rebalance the portfolio on a monthly basis. So just quickly jumping for a minute here, when the Nifty trailing 12-month PE, for example, trades at 24 times and above, the equity allocation ranges in the portfolio to the extent of 30 to 45%. And likewise, when the market valuations as reflected in the trailing 12-month PE of Nifty moves below 15, which is the extreme zone as per the last 7-year data, these are the times when the equity allocation gets maximized to 90-100%. So the whole idea is to capture those moments when there is extreme fear and kind of increase equity suitably so that we make use of those opportunistic corrective phases in the market. And likewise, when markets are extremely euphoric, start booking profits in a disciplined fashion. So bringing equity to 30 to 45%. And in between, we have 3 other buckets based on the valuations, the equity ranges move accordingly. Now, the whole idea here is that when we do this, we do it on a strict numerical basis. In the sense, we once the allocation bands are decided within the first week of the next month, the rebalancing of the portfolio is done. So if the band suggests that we move from say 60 to 75 equity to 45 to 60, the immediate rebalancing is done on the incoming month within the first 10 days. And likewise, why these bands are chosen at these particular numbers, which I showed you here. These are based on the past cycle data of how the markets have behaved. So just to give you in a simple statistical nutshell, these represent the extreme market compared to its average range of valuation. So typical 1 standard deviation is above where the markets turn either euphoric, or 1 standard deviation below, markets turn extremely pessimistic. So the extreme ranges represent those 1 standard deviations of the markets compared to its average valuation range, and the ones in between are closer to the I would say the average of the bell curve. Now, from a market perspective today, where has this currently been reflected? The way we have been reading markets in the last almost 6 to 8 quarters, markets have been gradually moving up. So the valuation bands have moved for us, suggesting an equity allocation of 45 to 60% today. So currently, as we speak, the Nifty trailing 12-month P is around 23.5 times, which is just 1 notch below or closer to where the 1 standard deviation sets in. And equity allocations are maintained at 57% for us consistently in the recent quarters. Now, how has this helped us? If you move into the next question of how this framework has helped us. So if you look at this chart here, it shows how the net equity exposure has moved based on the trailing 12-month PE. So the blue line represents the monthly average PE of Nifty based on a trailing 12-month basis, and the orange line represents the net equity exposure we carried in the fund. So if you look at the fund allocations started improving or increasing very drastically post the COVID phase. And since almost, I would say, October or September 22, the fund started pairing positions or bring equity back from 68% to 50% when the market was at that. And again, during the initial phase of panic when the Ukraine war started playing out, the fund started consciously increasing equity allocations at that point of time. So all these are in sync with how the PEs have been signaling. So if you look at as PEs expand, the allocations move down, and as the PEs turned attractive, the allocations moved up, and vice versa. So the pattern here is again exactly similar to what the product stands for. Make use of fear, more saner when there is excess greed in the market. So what kind of risk are we trying to capture in this process? So if you look at some of these key events which played out in the past, so whether it is between 2013 or 2015, 16, or during COVID phase or the Ukraine-Russia conflict, these were all short phases, anywhere between 3 months to 7 months or 9 months. But if you look at the drawdowns which markets had at that point of time, which is shown on the table here, these were phases where markets experienced between mid-single digits to almost high double-digit drawdowns in those phases. So if one were to have a portfolio mimicked on the methodology which I discussed earlier, the drawdowns would have been half of what the market experienced. So to stay away from equities when there is greed, and force oneself back into equities when there is fear. So in that process, the equity allocations take care of the risk by avoiding huge drawdowns when markets book profits or sell off for certain reasons, either externally or internally, India specific. So these are various reasons for which markets corrected whatever has been shown here, and the drawdowns for the portfolio which has been carved out of the methodology is half of what the markets had experienced at that point of time. So from an investor perspective, he is able to digest risk or volatility much better during those phases. And in fact, one is able to capitalize on these corrections by sizing up exposure during those corrections which ensued in these phases. So if you look at the rate table on the right, the equity exposure from a position perspective, say for example, during the Ukraine-Russia conflict, while we were at 53% before the conflict broke out, the conflict was an opportunity to increase equity allocations all the way to 67, 68%, making use of the corrections because the earnings didn't get impacted, whereas the prices got impacted. So PEs came down more attractive, and the markets provide an opportunity to size up exposure to equities. So this is exactly what we try to capture during these events in the market whenever drawdowns are happening. And in essence, what the model is suggesting is all about sizing up risk or sizing down risk using a framework which in our view is decided using the Nifty trailing 12-month earnings. So that's what the product kind of provides the investor in terms of what I would say like a shock absorber. Essentially, the investor is building shock absorbers through a exposure to fixed income or arbitrage and paring down equity when there is greed building in the market and vice versa. Now, how do we quantify the risk here? So if you look at the risk of the portfolio versus the risk of a plain vanilla index using Nifty as a proxy, a quick 2-minute glance into this slide would reveal that the drawdowns in markets happen for whatever reasons, either external or internal, and whenever those drawdowns happen, it creates knee jerks in the equity performance. So average volatility in the Nifty 50, which is the green chart, the bottom chart, what you see in the slide here, is close to 5.7, and average 5-year volatility, return volatility is around 3.2. For a portfolio which is constructed using a dynamic asset allocation framework, the volatility is half almost of what the primary equity benchmarkers. So the whole objective of the methodology of the framework is to bring down return volatility on one hand and make use of drawdowns to size up equity. So this is what we try to capture in terms of the risk of the portfolio. And are we sacrificing excess returns in this process? Again, I would say not exactly. If you look at the average 5-year or a 3-year CAGR of Nifty versus a dynamic portfolio like we construct here, the average 3-year, 5-year CAGR differential is probably not too much, but the risk is minimized to a large extent. So it's about a trade-off where we sacrifice slightly on the upside, but on the downside, a great amount of value capture is done in terms of minimizing risk. So this is, in essence, what Sundaram VAF stands for. And just to take you back to why this is important, we are living in a world today where every year in the last 2 decades, there has been some event or the other. So the last 5 years, in fact, it's relevant than probably what it was in the previous decade. So I've just brought it up to CY22 here because these were the years where we had one event or the other hitting the markets every year in the last 5 years. And in all these event-driven years, if some product had been there to maximize those opportunities or minimize, would stand tall among the rest of the category. So this is something where I would leave the message saying that for any investor who walks in with a risk-adjusted return expectation being a priority, it would kind of suit the purpose. And coming back here, how do we go in terms of equity allocation? In simple terms, this fund moves between equity, arbitrage, and fixed income. So within equity, this is a multi-cap portfolio. The allocation between large and mid caps is again a function of how the valuation differentials behave between large cap category and the mid cap category. And based on that, there is a stock selection framework which is then applied as an overlay. So how do we do stock selection here? So we have 6 broad parameters based on which the investment philosophy runs. So one is the potential of a particular business. So every business which finds its way to the portfolio has to have the element of scalability, which means 5 years out, when I look at the business, it should be of a much bigger scale than what I'm looking at today. So examples are plenty. If you look at what you're seeing in, for example, digital advertising in India, or if you're looking at financial services like capital markets, non-lending exchanges, these are businesses where the pattern of investments are driving these companies or businesses linked to this to a much better scale. Whereas you have some industries which are always mature or low growth industries, like, for example, lubricants, or if you look at paper and print advertising today in India is a very niche sector in a sense that market is moving to digital. So print itself is finding a very limited audience today. So differentiate business based on the ability to scale up is the first driver. Second, we look at progression. Once I've identified the space, the company which I'm screening does the company have the strategy in place or the capabilities in place to capture the growth? Not every company can become a market leader in electric vehicles. They need to get their product right. They need to get the distribution right. So are the strategies right in terms of capturing the business opportunity is what we try to look at. Third is profitability, which is again metrics driven. Is a company throwing cash for subpar profitability? Is the business by design providing room for profitability, or is the profitability very limited given the competitive intensity? What is the risk in the business model for the profitability assumptions that we are making? So profitability is the outcome of a company strategy, the space where it operates, and 3, the inherent competitive intensity, what is there in that space. Fourth is an ability to price oneself. Fourth is in terms of focus, what we call as pivot. Is the company disciplined enough to reinvest in the areas of focus, or is there been misallocation of capital? Is the leadership at the top smart enough to sense the undercurrents and the changes in the undercurrents? So some of the management insights would guide on this particular principle. Fifth is productivity. What are the strengths of the company which is giving the profit drivers? Is it something which the companies will be able to defend, or the companies can get disrupted easily? And here again, is it a capital guzzler or is it a cash generating machine? So all these come into terms of productivity metrics. And lastly, price. price is in terms of valuation? Am I paying too much for the growth that I'm assuming, or is this business? I mean, what is that we know in terms of insights on the business better than the market? To in case we are pricing the business, how do we price ourselves based on our insights on the company? So these are the 6 metrics which kind of drive into a stock selection when it comes to finding its way into the portfolio. And in terms of the fixed income part, quickly, like as I alluded earlier, this is all about focusing on safety first. So fixed income is not about alpha generation, but creating a shock absorber when we have equity drawdown. So fixed income forces itself into largely high quality papers of AAA and G6. Average duration, modified duration is around 4 years, and from a risk perspective, stay in terms of top quartile on the quality of papers that we've set in this particular portfolio. And currently, as we stand, this product has around 57% in net long equities. We have also the flexibility to invest in REITs and InvITs, which is more measured today at 2%. Earlier, we used to carry 5%, but the rate cycle is something which we keep our eyes on before increasing exposure. Today, we are at 2.5%, and fixed income and arbitrage is around 26%. So that's broadly in terms of a current portfolio election, and key holdings in terms of active bets. There are a good blend of large caps and mid caps, which we carry in terms of active bets in the portfolio. And currently, the portfolio is positioned towards on active bets towards consumer discretionary, automobiles, and partly in terms of capital goods in a current choice of sector bets. So these are broadly, I would say, the key sales of the fund. And just to sum it up, this is a fund which will dynamically move between equity and debt based on the market valuations as a yardstick. When markets are extremely euphoric, as reflected in the trailing 12-month PE, this fund has the flexibility to move equity as low as 30 to 45%. And when the markets are extremely fearful and showing signs of panic, based on the valuations, the fund has the flexibility to go to 90%. Today, we are somewhere one notch above the midpoint. We are at 57% net equity at this point of time. And there is a bias towards the larger caps today. Out of the 57%, 45% equity allocation is towards the large cap. REITs and mid caps are around 11%, and small caps is only 3%. Fixed income and cash put together is close to 40%. So that's what this product stands today. And the key salient, I would say, pitch points for an investor who walks in, again, to sum it up, it takes away the timing risk in terms of when to get out of equities, move into fixed income, how much to get out of equities, and likewise when to get back into equities. Because a fund manager himself doesn't take an active call here. It's a model-driven framework. So allocation calls are largely objective in nature when it comes to allocations. So from an investor perspective, the timing risk is exactly taken out. Second, it's done in a much more tax efficient framework compared to an individual doing on his own personal capacity, given that this comes under equity taxation. And third, from a market perspective, the relevance of it is much better compared to a past decade, given that every year we have been encountering one event or the other. So in zones of volatility, the product's relevance gets much more magnified. Under the current markets that we are in today, just last 2 minutes before I open it up, we have been in a market where FY24 was one of the best years in terms of corporate earnings. Across 1,400 companies listed in the NSE today, we've had an aggregate earnings growth of more than 28% last year, which has been the best ever corporate India had last year. And from that base, when we walk into the current year, which is FY25, earnings growth is expected to moderate, given that the base is high. Some of these drivers which help corporate India grow profits at such a pace, whether it is commodity gains, whether it is some coming back in case of automobiles, two-wheelers, all these, because of a high base effect, we will start looking at moderation. That is one. The government capex, which has been a pillar of investment-driven growth in certain sectors. We have seen an elevated capex spend now settling at a particular run rate. Incremental growth is moderating in terms of allocations, and we've seen fiscal consolidation now being a priority. So there is a moderation in terms of the level of spend, even though it's still elevated. And third, what we are looking at is the market action. So market action was showing signs of fear during Jan 23 to March 23, but post earnings playing out now, markets have started. In fact, markets have moved closer to what we call as euphoric zones, even though we've just shy of it at this point of time. So probably we are in a phase where market takes its own time to settle down in terms of time correction or price correction until the next phase of earnings momentum sets in. Having said that, 3-year, 5-year picture on equities is still fairly constructive. We are looking at a double-digit earnings CAGR being broad-based in our domestic market with various drivers built around investment and consumption and financials and services. But in the short run, there is a phase where probably one sees either a pullback on the growth rates of equities, corporate India, given the high growth rates of last year. And second is the markets from being into zones of reasonable valuations have moved up to a notch of what we call as one standard deviation above its past averages. So in that phase of market, it still might be for any investor who is probably coming in with a say a 1 to 3 year view, for him to position in a product like this where it makes use of corrective phases in the market, it can help capitalize on those market opportunities as and when those phases emerge. So I think this is where the current market context is, where three things. Drivers of strong growth are seeing moderation in terms of government capex as well as corporate earnings compared to last year. And second is in terms of our valuations versus the rest of the world, we've seen some amount of elevation happening where there is room to moderate in terms of either price or time. And three, as and when these corrective phases emerge, these have been fairly shallow in the last 3-4 years. And if one has to switch in, switch out, there would be obviously a lead lag involved, whereas a product like an asset allocation product like a dynamic balance advantage fund would make use of those corrective phases, even though they might be shallow in nature. So I'll stop here with my initial view on this product, how we read the basic contours of overall broad market valuations, market triggers and all. And any questions on any of these aspects, we can open it up for Q&A.
Yeah, thanks for that. Yeah, so I'm inviting Disha. She has collected various questions from the audience. Disha, over to you. You can ask the questions, please. Yeah.
Yes, sure, sir. Thank you. So yes, we have received few questions from our team and as well as our partners. So I hope it is visible on the screen. I'll just read out for everybody's convenience. So my first question to you is, how does the Balance Advantage Fund help in managing risk during an SWP compared to pure equity or debt funds?
Rajiv, you want me to take it or will you take it?
Sure, Bharat. I can take that. Yeah. So how does the Balanced Advantage Fund help in managing risk during an SWP compared to pure equity or pure debt funds? So essentially, when, as Anjanya explained, in the beginning of the call, an SWP is a method by which, one is looking at a consistent income stream. Now, when you're looking at a consistent income stream, what do you not want? You don't want volatility, right, to eat away your earnings or your returns. What BAF does is BAF as a product is designed for you to curb volatility, to have a smoother investment journey, and for your investment to have a smoother growth trajectory. So essentially, when you have a product where the growth trajectory is smooth, the volatility is low, in that kind of a product, SWP works extremely well because your consistency of income, right, with low volatility has a much higher probability than a pure equity or a pure fixed income product. I hope that kind of answers the question.
Yes, thank you so much for the precise answer. Moving to next question. So how does market volatility affect SWP return in Balance Advantage Fund and how it is mitigated?
I think it's similar to the earlier question in a way.
I think
Yeah, yeah.
So,
largely be the
Almost,
same.
yes.
Yeah.
The third one, what are the advantages of using an SWP in a balance advantage fund for retirement planning or regular income generation?
So, Bhavik, can I request you to share that slide?
Yes,
Is
Rajiv.
it possible for us to share a slide? Just it'll help us answer this question better.
Yeah, yeah, please do.
Yeah. So if you can just share that table that you had worked on.
Yeah, Rajiv.
So the table that my colleague Bhavik is sharing right now, essentially, I mean, this is a simple table which highlights how SWP functions. Now, if you see, there are certain assumptions that have been made, in terms of XRR, which is the second column. Now, essentially, this can happen for any product, and this would work equally well if these return assumptions were to hold true. The only point here is that volatility, again, going back to my point, that volatility is lower in a balanced advantage fund. The fund is designed to be lesser volatile. And if somebody, say, this is just an example for illustration, say somebody, today puts in 10 lakh rupees lump sum and starts an SWP amount, of 7,000 rupees, right? You can see that after a period of 10 years, he's withdrawn about 8.4 lakh rupees, for his requirement, whether it is for retirement or certain other goals. Even after that, there is a reasonable amount of balance corpus that is left. I'm not going through each number because depending on the scenario, whether it's 10-year, 20-year, or 30-year, the numbers would vary. Depending on the return assumptions, the numbers would vary, right? But essentially, the key again is that low volatility. And this kind of a product ensures that, you have a smoother investment journey, low volatility, and more predictability in terms of your income stream. So I hope that answers the question. These are only pure examples in terms of, the return simulations, just for simulation purposes. Yeah, yeah, Bhavik. Thanks.
Thank you so much for showing the illustration. I hope it is clear to everybody now because this is definitely bringing the clarity to people. So moving back to my slide,
Yeah.
just a minute. Yeah. Yeah. So my next question to you is how does an investor determine the ideal withdrawal amount for an SWP in balance advantage fund without depleting their corpus too soon?
Yeah, I think that's a phenomenal question. So yeah, so essentially here it becomes extremely important that the investor consults with his advisor, which in this case say is JM, and understands that if he has an X particular goal requirement, that he needs an X quantum of money coming to him every month for a number of years. It can depend on the goal, whether he wants, say, in case of a retirement, somebody retiring at the age of, say, about 57 says that, I have my life expectancy of the next 25 or 30 years, for which I need an income of 30 or 40,000 every month. His financial advisor thereby can help him compute what is the amount that he needs to save at this juncture or invest at this juncture in a balanced advantage fund with a reasonable return assumption, and then help him calculate what amount will help him get that goal amount in terms of SWP for the period that he needs. So it is extremely important that he consults his advisor in this case, because there's no one size fits all approach. Depending on the goal, the amount, and the period, the tenure for which he wants to withdraw the money, all of these calculations could change.
Yeah, perfect. Thank you. Thank you so much once again. Yes, my next question is, how does rebalancing in a balance advantage fund impact the sustainability of SWP? I think Bharat have already covered in
Correct.
one of these slides, but if you would like to throw some light on the same.
No, I think Bharat covered that in his slide already. So
Yeah.
I
Yeah,
think
yeah.
that's pretty
Fair
much.
enough. Yeah. Yeah. Next question is, what factors should an investor consider when choosing an SWP option in balance advantage fund versus dividend option?
See, I think one of the key differentiators is that in case of an SWP, the investor gets to determine what is the amount the income stream that he can get every month, right? In case of a dividend, it is the prerogative of the AMC, and the AMC decides, what is the dividend that's going to be paid out, right? Depending on various factors. But in case of an SWP, it gives the power in the hands of the investor to determine what is the money he's going to withdraw every month, what is going to come to him, which will help him fulfill his requirements. I think that is the single largest differentiator, and which is what kind of makes SWP a very unique sort of a methodology or proposition for investors.
Absolutely, makes sense. Thank you so much once again. And my last question to you is I've received in my chat box actually. So can you please brief the taxation part of it?
This is
It's a standard,
like any other equity fund.
Yeah, correct. So,
Perfect.
This functions as an equity fund. At all points in time, the gross allocation remains north, that is more than 65%. So the taxation would be in line with any other equity product.
And what about the withdrawal part?
Again, there the outflows would be exactly in line with how the outflows work in any equity product. So essentially, for short-term capital gains in an equity product, the capital gain tax is 15%, and for long term it is 10%. So that's the same methodology that will apply in this product as well.
Okay. Perfect. Thank you so much once again, Rajiv and Bharat, both of you. So you have wonderfully answered all our questions. Over to you, Anjaneya sir. Thank you.
Thanks, Sita. So Rajiv, if I may pitch in on the taxation aspect, while I'm not a tax expert, but one point which I believe makes our SWP as a strategy better than many other investment vehicles, where you're getting the regular inflow, is the capital gain instance, where what happens is when you withdraw in the initial months, suppose you are withdrawing, say, 1,000 rupees, just to give the example, you are not liable to pay tax on the total 1,000 rupees. Out of this 1,000 rupees, possibly 995 or even 990 or 950 is the principal component, while the remaining 50, 20 or 25 rupees is the gain component.
Yeah,
capital gain. So the short-term capital gain is applicable only on the 20, 30, 40, whatever is the gain part. If we just calculate even at the highest tax slab, a 30% tax slab on a 20 rupees or a 50 rupee even also, then also we are paying 15 rupees as a total outgo in the taxation plus the surcharges. So this way, effectively what happens is as we move forward, gradually the capital gain component keeps on increasing. But by the time we hit the 1 year or 2 years or 3 years period, long-term capital gain comes into picture depending on the nature of the scheme. And then the taxation automatically comes down on the gain part of it. So what we have seen is over the period, if somebody is continuing with this withdrawal, the effective taxation, considering last 8-10 years of withdrawal and the returns on that side, has been in the range of 4 to 6% of the total withdrawals. And that's one of the beauty of SWP as a strategy, which I hope all of us would agree is better in terms of tax efficiency than many other bonds or debt instruments, which are giving you the regular inflow. So if I just try and package this, correct me if I'm wrong, or you can add any other point. So in a SWP, 1, you're getting a regular inflow, 2, on a fixed date, 3, in a way with the tax efficiency that we discussed, 4, with flexibility of withdrawing anytime additionally or putting in more at any point of time. Now, which is where the slide from Mr. Bharat, which was actually very useful. If market goes up, what is the participation? If markets go down, what is the participation? People are concerned about how safe is my money, which I'm banking on for regular income. So I think your data points have actually in a way accentuated our liking for BAF as a tool for a systematic withdrawal plan. Your thoughts? I would say Bharat also to contribute anything which you wish to, please. Yeah.
Bharat, you want to go first?
I think it's a clear tool which has reasonable answers for risk part of the market.
Right.
And in general, for example, in case of BAF, it's like somewhere you are exposing yourself to the best of both worlds, but not taking too much on your chin, even in case there is a air pocket in between. So it's fine. So it's more from a risk perspective. And second, I think, what I showed earlier, in general, what we are doing here is very simple, right? At any point of time, if I assume the market is in a bell curve, 50 to 70% of your portfolio is long equity. So the 30 to 50% of the remaining will always have a fixed income accrual, and the 50 to 70% will generate alpha. And in between, if there are signs of risk, you pull yourself back. So you're topping up your longer term returns on a risk adjusted basis using a framework. So equities by and large have a edge over fixed income on a longer period of time. And in that journey, you're trying to mitigate your risk in between through a mechanism so that, even if somebody is not able to digest the risk, you're taking care of it to a reasonable extent.
In fact, one more thing that probably comes to my mind is we very often talk about rupee cost averaging when we talk about SIPs, right? But essentially, rupee cost averaging also happens with SWPs. If you look at it, reducing, the fact that you're withdrawing monthly, it reduces your market timing risk because you're selling units systematically over time, right? So the rupee cost averaging concept also works very beautifully in SWP, taking away your timing risk from you, right? Just like how in the case of investments, so in the case of withdrawals also. I think that also is a very interesting piece.
That's rightfully so. Bharat, may I request you to just put that slide once again for the benefit of those people who missed it probably or in the flow, where we had the range of returns,
Yeah.
Yeah. So that's something which relates to the point that we are discussing here.
Correct.
So which is why I'm requesting
it. The red ones here within the bars shows the average 3-year CAGR for the Nifty and average 3-year CAGR for a portfolio running on a BAF model.
Right.
And this is a 5-year CAGR. While it's not too stark, at the same time, what is more fascinating is the bottom chart, where your volatility is half of what a plain vanilla equity would have been. In fact, if you look at it on a 3-year or a 5-year, there's not been a single year where if an investor has come at the top of a cycle and if he's exited, there wouldn't have been a drawdown for him if it had been a pure BAF model. If you look at the one at the bottom and the one at the top here, these shows the extremes, and same on a 5-year basis. So even if some investor had been so unfortunate that he's come bang on the peak of the market and he's exited on a 5-year at the bottom of the market, he still has a very minute probability of a negative drawdown, whereas under a BAF model, the drawdowns are positive if held for 3 or 5 years minimum. So that's again while it's statistics, but it shows the advantage of capping your risk using a framework, and so that your drawdowns aren't negative even by a low probability.
So I would rather actually draw two positive outcomes from this slide. One part is our partners would also agree. Investors who are seeking regular income, they are not looking for very high return. If it is more than bank, that is fair enough. And in both the scenarios, whether 3 years or 5 years, it is evidently more than bank return. If you look at the average returns, say 10.4 or 9.7 is evidently more than the bank returns. And that even with the tax efficiency we just discussed about. And second thing, which is the comforting part, is in both the scenarios, actually, returns are still above zero. That is, they are not negative in all the possible periods or scenarios that we discussed. So these are two very interesting points. More than bank returns have been there for 3 or 5 years as per this simulation, and the returns have always been in positive. Added with the other actually even during COVID and Ukraine-Russia conflict, which is recent, market post-election rally and everything. So all scenarios actually it comes out as a better proposition than a pure play equity funds or any other risky venture where you can get a consistency of return. And Rajiv, if we just have to look at slightly longer period, of say 10 years or so, what has been the return of Sundaram Balance Advantage I think, if you
Sure.
just have it handy,
Sure.
yeah, please.
Yeah, I think we can just put that slide up. So, in fact, we have an illustration of how an SWP would have worked out. If somebody would have probably started back in 2010. Bhavik, can you just put that slide up, please? The other one, the one with the Sundaram BAF balanced advantage numbers.
Are you able to see this slide, Rajiv?
We are able to see that table only, Bhavik. The second slide with Sundaram BAF as an illustration.
1 second, I'll share it once again.
Sure. Since we were talking about SWPs, yeah. Since we are talking about SWPs, we said why not just look at, and actually if somebody would have invested 10 lakhs in Sundaram BAF, at launch back in December 2010 and withdrawn 7,000 every month, how would have that panned out? So interestingly, as you can see, the XRR scenario pans out to be around about very close to 10%. For somebody who's put in 10 lakhs and has started withdrawing 7,000, has ended up withdrawing close to 11.5 lakh rupees, over the period. And the value after all of that is still more than 13 lakh rupees. So again, this shows you, a very classic combination of, participating in the growth of equity at the same time, having a product that can help you curb your downsides during extreme events, and thereby, makes it a very ideal product for doing an SWP, because that you can bank on the fact that the stream of income that you've designed for yourself, you have a higher probability of getting that for a longer tenure.
And this is a
Rajiv,
period, Rajiv, if I can add,
Yeah.
a period where you have seen some of UPA government, then Modi government, you have seen COVID coming, you have seen Russia, Ukraine happen, and everything is been, captured in this. And, kind of withdrawal that the investor would have done is, 8.4% per annum, which ideally you wouldn't expect in a bank account or, even a fixed deposit for that matter.
so that's where 7,000 rupees part comes into play. 7,000 a month works out to close to 84,000, which is 8.4% on the initial investment of 10 lakh rupees. Very rightly said, Bhavik. I think it's perfect, bang on. So close to 10% CAGR, and despite withdrawing the 7,000 month on month, 10 lakh invested has a residual value of 13 lakh plus over a period of 10 years. So it's
And the
not that money
interesting,
has gone.
another interesting point, Anjanya, that the longer that you're keeping your investment, you're withdrawing that 7,000 every month. If you see the previous slide, you keep withdrawing for 20 years and look at that amount where it goes. The balance corpus, grows to 17 lakhs at 10%, rate of return. It goes to 30 lakhs in 30 years. So such an interesting thing to see that you keep withdrawing, but your corpus still, keeps moving up. Now, obviously, there is an assumption of XIRR, but then we have seen this in a back-tested thing also.
Just relating once again whatever points we discussed, starting from the point like Bhavik just mentioned in the end, if longer the period of the continuity of withdrawal, actually the remaining corpus is growing. It's not going down. So it's a comfort that whatever you have invested is intact, rather growing, plus you're getting a regular inflow. Second, as we have seen in case of Sundaram BAF, close to 9.9% or almost 10% kind of CAGR has been there for last 10 years, with investment value of 10 lakh growing to 13 lakh plus, despite the fact where you had actually withdrawn 7,000 month on month over this 10 years period, which is 11 lakh plus. Third, the taxation aspect that we discussed is something very beautifully in favor of systematic withdrawal plan. Fourth, Mr. Bharat shared the historical backtesting of the model, where the average return has been more than 9% or 8.5% plus, even 3 years and 5 years. And also in both the scenarios, there has not been negative instance. The minimum return is above zero. That is principal value has actually not gone down in that case. So there are various positives that we can draw from SWP as a strategy, and Sundaram's track record actually is very nice that we should carry it to all our partners and clients for them to take a conscious call, conscious decision on the options like whether they want a regular income post-retirement, whether they want to give a regular inflow to their housewife or homemaker who is probably not earning currently, she was earning earlier, to their child who is probably studying in a boarding or away from home, and you are giving the regular money or regular pocket money, etc., and various other innovative usage where your client feel this regular inflow can work out, keeping in mind the market volatility and also the taxation aspect, everything bundled into one. And closing on one remark by Rajiv, rupee cost averaging works for SWP also, not only for SIP. That's a beautiful statement, Rajiv. I carry it and I'm borrowing it and I'm going to use it in various other sessions, which
All
I
yours.
feel. Yeah. Thank you. So Rajiv, over to you, and then we can have a final conclusion. Thanks to Bharat for sharing his thoughts and insight. Truly helpful. Yeah.
Thank you.
No, thank you. Thank you so much for the opportunity, Anjanya. I think probably if Bharat had something to say, otherwise.
I think broadly covered. I think very helpful. Thanks. Thanks a lot for your time.
Thank you, Bharat. Thanks, Rajiv. Thanks, Bhavik.
Thank you.
And thank you all our partners for patient listening. And I'm sure this session will go in memories and, of course, in practical use from here on. And Sundaram Asset Management's Balance Advantage Fund, we look forward to adding in our kitty. And let's have the conversations on ground with our partners and client to make a real package of systematic withdrawal plan with Sundaram Balance Advantage. On this note, let's conclude and let's start our journey on business front. Thank you so much.
Thank you, everyone. Thank you.
Thank you. Thank you so
Thank
much.
you.